It's almost investors. We don't believe it. We don't believe it. We don't want to believe it. And then, boom, down 10% we are.
Meta was going to be my Mag 7 stock of the week.
The drum roll.
Was it?
Was it?
It immediately fell 10%.
Oh. Yeah, it's a bit like saying, let's sell our gilts and put 10% in S&P. It's like putting your money on black or your money on red. That's what you're doing.
Maybe some of the US institutions particularly don't like the fact that they are friendly with Russia and with Iran. So, maybe they're being punished at the margin of that. Now, at the same time, this market is quite an expensive market. Their price-earnings ratio is a bit high. Oh,
my goodness. Crypto, VanEck, what's it doing to us? Down 11.5.
Yeah, I love the way always you pass that hand grenade to me, Funny enough. Oh, boom, here we go.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. To IG's award-winning podcast, The Art of Investing, with me, Rich McDonald, here to bring you the latest insights into the investing world each week. To help me with this, my resident experts in the bond world, Chris CJ Fellingham.
Hello, Richard.
And my equities expert, Mark Spice Holden.
Hi, Rich.
But before we get started, we would really appreciate if you could leave a rating and review on Spotify and Apple Podcasts. Makes a big difference in helping grow the show and keep bringing in you those fantastic guests. Now, we are here for a double special this week. It is not only our quarterly review, so a reminder, every 3 months, we look at every single position we've got. We've got the graphs out. We've got everything ready to bring you our thoughts on each position. And a reminder, CJ thinks that even if you consider yourself a passive investor, then every 3 months is just a good time to take a little bit of a look at your portfolio and see if you're invested the way that you mean to be and what you're exposed to. Secondly, it's our Easter special. You can see in front of me, CJ, you've gone and bought us some chocolate, or at least you had.
Yeah, I'm afraid that it never lasts long. I'm a bit of a binger in whatever I do, whether it's binge drinking or binge eating. Having seen that in the supermarket, thinking I needed to get my sugar levels up a little bit, I've now gone and eaten most of the egg.
Good.
So we can now move that, so it's not in anybody's way, and that's gone. But happy Easter.
How are we doing, chaps? How's the week?
Well, it's been a bit of a challenging week this week because the dog's back home after her stay at the doggy hospital.
Big shout out to Poppy.
Unfortunately, Bupa doesn't cover her, so I had to access Mrs. F's housekeeping money, and that's gone down very badly indeed. More importantly, though, yesterday was Stuart Nyman's funeral, and that was a very, very sad event. 62 years old, leaving behind his lovely family, including 4 children and his lovely wife, and many, many, many friends. There were up to 200 people turned out yesterday for the service. Great turnout, a long day, but an essential way to start the grieving process. So, we're all going to miss you, Stu, but life goes on. And in his favourite phrase, it was used at the service yesterday, JFDI, which in English means just do it. Now, if you want to bleep out that word, that's fine. But I just wanted to get that in there because that was what he always believed. So I'll say JFDI and return it back to you, Rich.
Well, I think after Nike's profit warning last night, perhaps they need to add something into their new slogan, don't they, Spice?
They have their shares down 10% after their profits warning. Like you say, they just need to keep doing it.
Yeah.
But it's a shame. They're continuing to struggle to turn the business around and struggling. If you remember, we've always said that companies often have profit warnings that don't just come in packs of 1, they come in packs of 3 or 5. And I think we're into probably the 3rd one now for Nike. It's been a pretty disastrous share price for the last couple of years, particularly last year. We had a pretty torrid into last week and the beginning of this week, and the Nasdaq moved into what we call correction territory, if you remember. So down just over 10% from its recent high, and the S&P 500 was down 9%. So big falls. But in the last 24 hours, we've seen quite a big turnaround, and no doubt we'll talk about that a bit later. But the S&P, until this turnaround, and so until the end of last week, had its 5th down week in a row, and that's the biggest fall in about sort of well over a couple of years. So things look a little bit brighter, as I say. In the background, actually, the earnings have been improving in the S&P, but the PE ratio, or the price earnings ratio of the overall index, because the earnings have been going up, the index has been coming down, the price earnings ratio has fallen, making it more attractive potentially to investors. So we'll talk about that more when we do our review.
Can I just say, you said there, and I just think it's better to clarify, you said about the fall being the biggest fall. What you meant was the longest duration fall of 5 weeks.
Absolutely.
Clearly, it's fallen more than that at various stages, but that consistent down motion every week is an unusual circumstance.
Well, that was it's almost investors. We don't believe it. We don't believe it. We don't want to believe it. And then, boom, down 10% we are.
I described it last week as a death by 1,000 cuts, that's what it feels like to me, because you don't get that big sort of jolt downwards that people can go by the beep dip. There's a lot of beeping going out today.
Yeah, wow.
It's all that chocolate.
But anyway, so yeah, it was instructive. But I'd say the last 24 hours, maybe we've seen a bit of a change in mood there. In the background, there's some big deals being announced. Unilever, one of the UK's biggest companies, have announced that they're merging their food and ingredients business with a US business called McCormack. And basically it's about 35 billion in value, this new company. But it includes Unilever brands like Hellmann's mayonnaise that we all know and love, Knorr, which you put into your cooking sauces and all the things. But for me, my favourite's McCormack's. They've got Frank's hot sauce, gotta love a bit of spice there, and all the Schwartz spices. So, a good combined merger, I think that will do. But interestingly, they've left out their Indian business. So Unilever have a huge business in India called Hindustan Unilever, and basically I think it's India's sort of 9th or 10th biggest stock. So it's a big business, but that's been left out of this merger deliberately. The Indian business is standalone, and it's still doing pretty well, actually. Elsewhere, we've had, interestingly, sort of a side beneficiary to the war was that Tesla's electric car sales in France trebled in March.
Of course, because of the price of oil, right?
Yeah, exactly. And, unfortunately, Tesla's been under the cosh that their electric car sales across the world have been suffering. And maybe it's an indication that people are going, do you know what? I'm not giving up on electric cars just yet. We'll see whether, what 1 month makes a sort of a summer or a spring for them. But interesting.
It's an interesting thought process, isn't it? Because my electricity bill is going up as well.
Yeah.
So I'm not sure how they charge their car.
Oh, but you don't have to queue up for it. You see, one of the reasons, I think, is not just the price. It's the fact that if you get to rationing, the odd numbers in your registration say you do Monday, Wednesday, Friday, and the even numbers say you do Tuesday, Thursday. There's all this sort of talk about there might be rationing at some stage. And by the way, let's just put it out there, I'm not talking about rationing. That's not right. There's so many people listening to this podcast, I don't want them all to rush out and fill their car up straight away. It might be a problem. He joked. At the end of the day, that's what people are thinking about. So actually, at least with electric car, you charge up at home, and you don't have to worry about it in that sense.
Yeah, I mean, the other sort of stories that have been building, remember I talked a couple of weeks ago, about Meta, who own Facebook. There was a rumor going around that they're about to lay off 20% or more of their employees because they are now starting to see the benefits of all their AI investment starting to flow through. So in terms of efficiency, now, of course, that will be good for share prices. And I have to point out that when we did our little competition that IG put out last week, and I said Meta was going to be my Mag 7 stock of the week.
Yeah. Was it? Drum roll.
Was it?
Was it?
It immediately fell 10%.
Oh,
but it's now back up, and it's actually 4% higher than this time last week. And we talked about it. So net, winner, chicken dinner, as they say.
That is, of course, the competition we spoke about last week. The beat the street. So we tested the guys out, but well worth going back and checking out that episode.
Yeah, I'd say the main reason Meta benefited is because of this potential layoff of workers, which is not great for the people being laid off, of course, but is good for shareholders in the terms of extra profitability that could flow from that. And the other company that's rumoured to be now thinking about that is an old favourite of yours, Rich, and mine, Oracle. So they're rumored to maybe look at that. And actually, their shares have been very weak, like so many other software companies and AI-involved companies. We're just starting to see maybe a turn in that. And we'll see. But I think the next reporting season, which doesn't happen for a little while yet, I think people are going to look very closely at whether companies are getting benefits from AI, and particularly from all this CapEx. And we've identified before that companies where they raise the CapEx by more than expected are being punished. The share price go down. Where they've come in line or a bit below expectations, the share prices have gone up. And I think companies are now sort of on top of that, and we'll see how they deliver in the next set of earnings.
Yeah, interesting. Great numbers from Oracle a couple of weeks ago. Stock hit $158. It's now down at $140.
Yeah, I know. Obviously, the markets have been weaker, but it's interesting. On the up days, they do better than obviously some of the other things that are going up.
What was its peak last year when it had that great announcement? What did it get to?
$350.
$350, and it's now $150.
So his wife told me to buy it.
Well, follow the advice of this podcast. You can't go wrong.
Then there's another one. It's Micron. Micron had great numbers last week. Absolute blowout that you covered. And the stock was trading at, it got up to $460. Yesterday, it hit $320. I mean, it's a little bit of a stock-specific situation. They sell memory, and memory has been short in supply. So DRAM prices have been going up.
Yep.
But it's cyclical, right? And people kind of forget that it's cyclical. But I would not have expected the stock to fall back by, what's that, over 35%?
Yeah, I mean, the markets can be very brutal. And there's no places to hide sometimes when those sort of things happen, because people are looking for the next disaster or the next sort of one to pick on as well. But yeah, we're going into a quiet period now for reporting, and then that will accelerate again as we sort of, in about a month's time, we'll start to see more results come through. And that's it for the market update.
Wow, 10 minutes.
Yeah, well, I'll tell you what. There's a bit of a record there. It's like, I'll add a little bit about, we talked about Sonia last week, my girlfriend Sonia.
Yes.
Sterling overnight interest rate, or interest average actually. And it had gone from discounting 2 rate cuts before the crisis to 5 rate rises at the worst. And it's now down to under 2 this morning. So I think we were right to identify it as a mispriced market last week, and helps us to give a judgment on what the market is discounting in terms of those rate moves. I think when you look at the longer bond market, the 10-year bonds, so remember that's bonds with 10 years to maturity, say in the UK, they were yielding 4.2% and got up to over 5 at the worst last week actually, just at the tail end last week. We're back down to 485 now. So we've seen a rally in all these interest rate contracts, whether it be the Sonias, whether it be the longer maturity. But there's still a long way to go if we're going to go and discount the levels we got to before. So better performance from the bond markets, more logical now, but still a long way to go if we are getting closer to the end of this hostility.
I think my big takeaway from the week was previously with oil at 100, potentially going higher, the market was very much saying, okay, higher oil price equals higher inflation equals higher interest rates. But stocks weren't really budging too much on that. And suddenly we've gone to higher oil price equals higher inflation equals a really big hit to growth. And so now there's all these concerns around economic growth, and the names that perhaps they don't make any money at the moment. Some are even pre-revenues, but the ones that really are on high growth multiples but make their money 3-4 years in the future, those have been absolutely smashed this week. And so the market is now really focused on economic growth rather than these rate increases.
I think the interesting thing is that there's a big divergence in where these interest rate increases might be being discounted at the moment. So we talked about Sonia, CJ's favorite girlfriend, and basically the same thing's happening in Europe. If you look at the expectations for European bonds, they're expecting, again, 3 interest rate rises over the next 12 months or so. And that's the same in the UK. It's got up to 4 or 5, actually, last week's back to 4 now or so. So it's still a big number of increases. But in America, if you look at the probabilities of an interest rate rise, there's only 18% probability of 1 interest rate rise in the US. So there's basically a 75% probability that there'll be no changes at all. Now, if you went back 3 months before the war started, we were looking for 2 or maybe 3 interest rate cuts in America. So those have been taken out of the market for now. In the US particularly, they're sitting on no change. Of course, we've got a new Fed chair that's will be coming in at the end of May. And we'll see how he tries to sort of please Mr. Trump. Trump's obviously put him there for a reason, and I suspect he's going to be talking, dovishly and probably more in favour of rate cuts. But whether he can do with his hands are tied with the oil price having done what it's done.
So there's 2 expressions that come to mind for me here. One is can't see the wood for the trees, and the city knows the price of everything and the value of nothing. So let's rise up a little level here and say, if in January I had told you that we were going to raise interest rates in the UK 4 times, US, remember, was discounting 3 interest rate cuts, 4 interest rate cuts. We weren't going to get any interest rate cuts. You would expect markets to be a long way lower than they are now. Everybody is going to their economics textbooks and saying, oil up, inflation up, interest rates up. My other word for that, as I said last week, is bollocks.
Another beep.
Because it's not going to happen. It's rubbish. And the market is getting found out on that now. As we just see just today, Trump's going to give some speech at 9 o'clock tonight. God knows what it's going to be on. S&P was up 2.5% last night and up another 1% today. What it's telling you is people are looking at the old scorecard of how these things develop. Oh, if this happens, that means that, that means that. And they're not thinking about it. There's no way we're going to see those rate moves. That's not going to happen. And that's what the market is telling you. And I'm very pleased that we're sitting here as we are, and seeing the movements in the markets that we're seeing.
Remembering as well the previous time that we've had oil spikes or problems in the Gulf, the US hasn't had 40 trillion of debt to deal with and pay interest on.
Absolutely. And, there are lots of positive things actually in the background. Take the UK, for example. The consumer has never been in better shape. We have delevered all the balance sheet. People have got lots of money to be able to pay for this, that, and the other. They may have to sacrifice their 3rd holiday or whatever. But at the end of the day, there's plenty of money around to deal with these issues. As far as I'm concerned, we're not going to see as many rate rises, market discounts, and we will see a more benign environment going forward. But let's not spoil the fact we've got a quarterly review coming up with the conclusion before we've even got to it.
I wonder if that's called talking your book.
It certainly is. There's no doubt about that. That never stopped me in 40 years.
Let's go on to have a look at this week's portfolio then. The bull moves, the best performers of the week have been copper, up 1.7% after a dismal couple of weeks before that. FTSE 100 up 0.9%, perhaps a bit of a defensive element getting felt there. The US has really underperformed this week against Europe, having some kind of bounce back, hasn't it?
Yeah, and I think the weakness of the sterling, the pound against the dollar particularly, remember, helps the FTSE 100 tremendously. And unfortunately, the pound has been pretty weak over the last couple of weeks, particularly. Even the euro's been weak as well. And I think there's a bit of a falling out. Obviously, the Europeans falling out with the US has probably seen some American money taken out of places like Europe and the UK, taken back to the US. But I think the UK has to also grapple with the fact that in just over a month's time, we're going to be sitting there with the local election results. And I think if you're an international investor, I said before, you're probably sitting there thinking, we don't know how this is going to turn out and we don't know who's going to be in control. And if they get rid of Starmer, will someone more left-wing come in and more profligate with with government spending, come in, and that could be damaging against the pound. So I think you're starting to see maybe an element of that. But as we said before, that actually helps the FTSE 100, doesn't hurt it.
Worth noting, actually, the way we structure this performance. So we are recording this on Wednesday, the 1st of April. April Fools.
April Fools.
Yeah. We'd love to April Fools you, but you're not going to see it.
By the way, people listening, we aren't the April Fool.
Despite our best efforts.
Let them decide that in the comments, I think. So we've taken a snap last night on the European close. So that was at 4:35 p.m. last night. This performance is snapped. And then that goes into the numbers today. So, of course, that was Tuesday. We had a massive rally last night. We've had a further rally this morning. So the numbers that you see, remembering that we are a long only, fund in that we don't have any short positions. These will look much better as we speak right now, but we'll keep it from Wednesday night till Tuesday night this week. The bears, oh my goodness, crypto, VanEck, what's it doing to us? Down 11.5.
Yeah, I love the way you passed that hand grenade to me, funny enough. Oh, boom, here we go. No, I mean, look, it's down 11.5%. I mean, that as of last night's close, if you look this morning, it's only down 6 because there's had a rally back up. So we know it's an incredibly volatile position in our portfolio. That's against Bitcoin being down nearly 5%. So actually, it's done worse than Bitcoin itself in the last sort of 5 days that we've been looking at this. If markets do rally back up, we would expect it to benefit on the upside. It's being hurt more on the downside when things happen, but we expect it to benefit more on the upside. It's got what we call a high beta, which means a beta of 1 means that the share price will go up and down exactly in line with the market. If it's 1.2, then it will go up 20% more than the market over a period of time.
And
if
down
it's
20% more than the market.
And if it's 0.8, it doesn't go up as much as the market as well. So it's a bit more defensive and a laggard, as we would call it.
Is it worth defining alpha there as well, Chris? All this alpha that you produce for us each week?
I'd like to say I produce alpha each week, but let's leave that to the listeners again to write in their comments. But, alpha is how much you make above the market index, or how much you lose against the market index. Clearly, a negative number is not what you're after. What you're after is to provide positive alpha, and meaning you have outperformed the market. Now, clearly, what that does depend upon is what you regard as your benchmark. In our portfolio, we have said, remember, that our benchmark is 10% for a year. And what we've got at the moment, looking at your numbers here, since inception, we are still up 11.1%. So we have positive alpha. Now, that's 1.1 positive so far since inception, but obviously on an annualized basis, because we've only had 6 months, that would mean that we've done considerably better than that. But as it stands at the moment, we are beating our benchmark. Some people call it a bogey. So we're beating our bogey, so I have still got a job as the chairman. Clearly, if we start slipping down the other way, then there may be shouts from the audience or from my fellow presenters for a change at the top. It could be like the football manager. We have plenty of faith in our manager.
Oh, we do.
Until you fire him. Let's see what happens.
Other bearish moves this week: S&P hedge down 2.7, emerging markets down 2.4, and India down 2.2. But like I say, all those have moved dramatically overnight. So a little bit redundant on the numbers this week. That gives us a week-on-week performance of down 1.36. If we took the snap this morning, Spice, is it worth just noting?
Week on week, we'd be up about 0.5%. Okay. So actually, we'd have completely eradicated that 1.4 loss, and we're basically up about
a couple of percent from there.
From last night. So,
is what it would be.
Yeah. Which is nice because we mentioned the S&P 500 was down 5 weeks running. We've probably also matched that. So it'd be nice to have an up week at some point, please.
It would be nice to have one, but of course, I can't dictate which days we're going to do our pricing on. I'm hopeful, clearly, that if the markets do well tonight, then if we'd have done our normal Wednesday to Wednesday, we would actually have been up. That's what I'm saying anyway, and I'm sticking to it.
Think you know your markets? Well, now's your chance to prove it. IG's just launched Beat the Street, a free weekly finance quiz where you can win real money. 6 questions. It'll only take you 5 minutes once a week. No trading account needed. No money at risk. Just your market knowledge versus the rest of the UK. There's a share of £1,000 in Amazon vouchers every single week and a share of up to £10,000 in cash if you nail all the rounds and our monthly bonus question. It's all completely free to enter. Search Beat the Street on IG or head to ig.com/UK/beat-the-street to sign up. T's and C's apply. The Beat the Street competition is open to UK legal residents aged 18 and over, and there's a limit of 1 registration per person. The promoter is IG Trading and Investments Limited, and you can enter and find the full T's and C's at ig.com/UK/beat-the-street. Good stuff. Right. The quarterly review It's exactly as we say on the tin. My normal advice to the students that I teach on investing is try and look at your portfolio as much as you go to the dentist or to the optician. So that could be roughly every 6 months. But if you're more focused on it, and I would imagine because you're listening to this podcast, you are, then every 3 months would be suitable as well. So what we're doing here is we're going through all our charts, which hopefully you'll see on screen on Spotify and YouTube as we go through the line by line positions in our portfolio. And we're going to discuss what our thoughts are on them. And then at the end, hopefully come to a conclusion and a consensus on what should be done with the portfolio.
We're going to go to our quarterly, but I think what we need to think about is the macro environment first, just before we go into that quarterly. I'd obviously prepared a long speech about my global views, but as my name is not Trump, and I don't know what he's going to say tonight, it would be a complete waste of time for me to talk about that, so I'm not going to do that. All I can say is look at the market reaction and how the markets are moving. I hope the regulator's been busy. So, risk on in this last 24 hours makes it likely that some sort of piece is coming. And I actually think, as we've been discussing with people over the last few weeks, we are going to get a result. Donald does a deal. It may be a very unsatisfactory result. He might just say, I've won, you've all lost, and that's it. I'm taking my military home with me. But at the end of the day, it will be some sort of deal, is what the market is sensing. Unfortunately, if that happens, the market will love it in the short term, but there's still going to be lots of problems coming from the region. But it will be able to sort of put that to one side. I think the other thing that the markets have shown us is, and I think we've talked about this last few weeks, how Trump derangement syndrome has made everybody feel very bearish a lot of the time because they generally don't like Donald Trump. Now, I'm no great friend of Donald Trump in any way, shape or form, but we, as an investor, we have to be a little bit more even-minded, and we need to learn and look at what's happening. And what you're seeing is the minute there's any bad news out there, the market comes off a little bit. But whenever there's any good news, it jumps higher. Mm-hmm. And what that tells you is people are short and people are defensively positioned. So generally, as long as no surprise happens later on today, I think it's actually going along the lines of what Mark and I have been saying along the whole time. Deal will be done. It may not be a great deal, but everyone's positioned for it to be a disaster. So if we carry on like this, the market could go up, and it could go up quite sharply. And I think that, to me, is the sort of background that I would talk about for our quarterly portfolio review. So just then reiterating what Rich said earlier, remember our advice is that you should at least quarterly look at your positions and your exposures and think about whether the reasons you originally had for your position still hold. And if they don't be a rabbit. And people who've listened to our pods will know what I mean by that. But if you haven't, this is your first pod, go back to episode or pod 19, where we describe different types of investors. One of our best ever episodes.
With Lee Freeman Shaw.
Before we look at each holding, though, I think it pays to look back over the quarter. Let's just spend a little bit, maybe a minute or two, being a bit more reflective and think about, with the benefit of hindsight, what we could have done better. But we have to be realistic. We can say with the benefit of hindsight, oh, well, I always sell the highs, I always buy the lows. And I have a number of friends who tell me that the whole time. But that's unrealistic, and that's for the birds. So at the end of the day, if I look at myself, and I look at what we've done with the quarter, a bit of inward cogitation, sounds very painful. We talked in Jan-Feb at length about getting complacent, how the returns we've been seeing were higher than we would expect, and wasn't this great? And, it's not normally as easy as this. It's not normally like that. And with the benefit of hindsight, we were getting complacent. And we sold several things really well. We took half our Japan out, or took a couple of percent of our Japan out. We sold we sold some gold holdings. We sold some US. We did some of those things. But the bad news was we bought other things back when we should have just held the cash. And a little shout out here for Rich. It's not often I say much to do with Rich, but Rich actually was the guy all the time who was saying, we don't need to put the money straight back in. We could just hold it in cash for a little bit. And the charts were clear in things like silver and gold, that they were bubbles and they were driving forward. But there were still the same charts in the FTSE and EM as well, well ahead of their moving averages. And in hindsight, it is hindsight, but in hindsight, we could have taken a breather, taken a bit of money off and put it on the sidelines. Now, I'm not going to give Rich too much credit because it would be wrong of me to do that. I want him to get over his skis. But also, remember, Rich was reluctant to buy the things we were buying in the first place, so we may not have had stock to sell if we'd listened to Rich. But that shows you, once again, the benefit of teamwork. And when it works well, we bought them all, we could have sold them all nicely and had a bit more cash. But what we've done is we've actually stayed pretty invested, which we're happy with in overall direction. But if we wanted to be harsh on ourselves, we could have had a little bit more cash.
And I think everybody at home can look at themselves in the mirror and probably say the same thing. And it's this constant messaging that comes on social media from a wide range of people that is time in the market. You can't time the market. Well, it's possible. Yep. You could see this time it is very possible to time the market. And I think people really need to open their minds more to what we talk about each week, different diversification and slight changes to people's portfolio. They don't just need to buy the S&P 500 and stay in it forever.
And when we look at it, remember we've talked before, the timing schedule that we work to means that it's difficult for us in the sense that we are doing the pod normally on a Thursday and we make then the decision for the Friday. And of course, markets move. So we want to be very convinced of something before we do it. But I'm just saying we could have, given how expensive the things looked on the charts, we could have held some more cash when we sold those things and retained it to invest in things at a later date. We didn't. Has it done us any harm? Not really in terms of our results, but we could have been a lot better. And one of the things I think we were talking about beforehand, before we chatted here was, if we take our mind slightly out of the podcast for a minute, and we look at what we're doing, we do on our own account. It won't surprise anybody who listens to this that we are active dealers and traders most of the time in our own positions.
With IG, of course.
With IG, of course, the best platform out there.
Which is actually how we met in the first place, because
Correct.
We were all clients of IG and our client manager brought us together and we had lunch, and that's how the idea behind this was formed.
So, but if we take the fact, and this is for the shorter term trading fraternity out there, we have all been adding a little bit. We talked about Sonia last week, for example. I think we all bought our Sonias. I think various people have been buying their positions. With the market doing what it's done today, you're probably going to take a little bit out of the market to say, phew, that's good. But from a longer term investor who stayed in it because we like the outlook for equities and we like the compounding nature of their returns, it's better for us to stay in and hold those positions. That's my feelings about what we did in the first quarter. Anybody else have any commentaries about the first quarter before we go on to the review itself, about any lessons? If we look back, was there any other regrets?
Well, from my perspective, I think obviously hindsight is a wonderful thing, but I think maybe we were a little bit too negative on the US relative to other regions. And I think that, from here, we have to ask ourselves, with the one big beautiful bill kicking in, with actually the fact that America itself is energy independent, they have energy independence, self-sufficient, whether they will be a major beneficiary for the rest of this year, while places like Europe and the UK might still struggle dealing with what might stay higher oil prices for longer. And obviously we have the expectations of these rate rises in the UK and Europe coming through, whereas in the US they've gone from taking rate cuts out of the market, but they haven't gone to putting rate rises in. And I think that's something we have to consider as we go through this review now. Are we geographically positioned for the next 6 to 12 months, given our positions? Because we've taken a lot of positions out of the US, and that played really well for us for that first, for most of this first quarter. We were big beneficiaries of that, and the whole world was doing the same sort of trade. So we were actually doing pretty much what everyone else was as well. The question is, will that continue? And that's the thing I'm sort of continually debating with myself.
My takeaway from the first quarter, probably the way that we've set this up, actually, we've got this wonderful model portfolio, but I think we all agreed that there was only 3 or 4% left in it. So I think at some point, maybe in the next series later on this year, we could talk about the options market, because the options market could have given us that wonderful opportunity to sell the upside on a lot of our positions, which generally just means that, right, we're very happy to hold these positions. We think they go up another 4%. But if we then write a ticket to say we guarantee that we'll sell them up 4, we can receive a couple of percent for that. And that might have just helped us on the position. If we had our own ETF, for example, then we could do that. And it would be a lot easier for people to understand. And that would be part of the performance. So that's just something for the future, not necessarily a criticism or a reflection on the first quarter.
Okay, thank you. Let's move on to the positions themselves. And we're going to take some individual positions, but we're also then going to group some positions as well. So we make sure that we get through them all. What we are going to start with is the worst performing position, or the worst performing market that we hold a position in over the quarter. And we're going to work from the worst up to the best. So the worst position, or the worst performing market that we held, was India, and it was down 15% over the quarter. So spicy.
I am the man trying to catch the hand grenades. Go on. I don't mind.
So spicy. My old friend,
the naive bull.
What's gone wrong with India, and are we comfortable to carry on holding it? Do we do the rabbit? Or do we do something about it?
Well, I think, let's remember why we put India in the portfolio in the first place. Actually, until the last 6 months, India as an index has outperformed the S&P 500, ironically, over the last 5, 6, 7 years. It's been a great performing index. And that's been fueled by some pretty positive fundamentals. In other words, demographically, the Indian population is still growing and expected to grow as a whole for another 20 years or so, if you look at the World Bank sort of statistics, etc. Whereas Chinese growth has peaked out and is now beginning to sort of, population-wise, beginning to sort of decline. And that's what attracted people to India, perhaps out of China, to try and take advantage of this. Because within India's population, there's also a massive and fast-growing middle class. And most Indian people are very sensible. They like to save, and they do it week in, week out, and they like buying their own stock market. And so the majority of people owning the Indian stock market, the Nifty 50, which is what the biggest market, is basically domestic Indian people. And that savings culture means that week in, week out, they're putting money into their market and they're putting money into the market. Whereas some other markets like the UK, very few of our people in the UK actually own UK equities. Most of the holders of UK equities are overseas institutions or big institutions, not individuals like they are in India. So that fast-growing middle class, good savings culture. And they also benefit from the fact, for a while when Trump was having a real go at China, China was almost deemed totally uninvestable. Particularly if you're a US institution, we talked about the power of the US money because they control 70% of the world's assets. They were reluctant to buy anything in China for a period of time. And therefore, if they wanted to get exposure to the Asia and the Middle East, they might have gone by Korea, Taiwan, but they certainly bought a big chunk of India. That's one of the reasons we were in it. Now, what's changed? And this is what we've got to ask ourselves. What's changed recently? Well, I think China has become a bit more investable again. So at the margin, that money, rather than going into India from, say, the US investors, has been going into China at the edges and other emerging markets. That's one of the reasons we like emerging markets. We've perhaps got a chicken's position in that we're not owning China directly, but we've got a big position. We've got 10% of our portfolio in emerging markets, and that's important. The other thing is, of course, when Trump laid out his tariffs, he slapped a 50% tariff on India.
Yep.
Having originally been 20, he ramped it up to 50% because guess what? They were buying their oil and taking minerals and metals from Russia and Putin. And of course, Iran as well, as we now know. They were also taking a big chunk from Iran. Now, he's cut that back from 50% down to 20%. But that was very damaging, actually. With hindsight, again, hindsight's a wonderful thing. But really, for most of the last few months, that 50% tariff was clearly weighing on international investors' minds and has played at the edges to subdue it. Maybe some of the US institutions particularly don't like the fact that they are friendly with Russia and with Putin and with Iran. So, maybe they're being punished at the margin of that. Now, at the same time, this market is quite an expensive market when you look at price earnings ratios. We've talked about that before. It's one of the ways to value big stock markets. And their price earnings ratio is a bit high because domestic growth in India has been still good. It's running about 6%, but it's a bit lower than it was before. It was running at over 7%. And when instead of being expecting, like many countries, expecting interest rate cuts, now they're expecting interest rate rises potentially. And because they have to import so much oil, they're importers of oil, with the oil price doing what it is, that's then seen, as you alluded to earlier on, Rich, if you have this higher oil price, that can be damaging for countries that have to buy oil externally for their economy, and that hurts their cyclical side. So some of the big positions in India are banks, and banks generally suffer when you worry about the outlying economy because there are bad debts that come with that. They also don't perform particularly well when you have interest rate rises expectations. So they perform quite well when interest rates are falling and when economic growth is picking up. And a big chunk of the index in India is banks and financial companies. And so it's hurt them at the edges. Now, the question is, what happens from here?
Well, that's the key. So the key really is, I'm hearing a great story, but I'm not actually hearing what the catalyst is for change. The question back is really, is this a value trap? Here's something where I can see good growth in the future, big population, dynamic economy, blah, 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 blah. But everybody can see that anyway. So what could be the catalyst and why should we stay with that position, I suppose?
I think my own sort of concern is that now China is investable again, India is going to continue to struggle against that backdrop. And if you started with a blank piece of paper, would I have 5% as we do in India now? I might have said with perfect hindsight, do you know what? Actually, I'll have less than that, but I'd put more in emerging markets. So you're still getting a bit of India in there because India is still the fourth or fifth biggest part of the emerging markets index, but we get more China. And I'd say if this continued making China investable again, maybe Trump should think about how would that make China investable again. then this flow that we're just naturally seeing and weighing on Indian stock market against other markets could continue for a while yet. So I'd suppose if you put my neck on the block, I'd say I'd take some little bit of money out of India and I'd put that money into emerging markets. So you're not completely coming away from the position, but you're getting maybe more of the other stuff that could continue to do it better.
Okay, all right, let's move on. We'll sweep up afterwards. We're moving now on to our second
That's the VanEck
chart, the VanEck Crypto and Blockchain, and that's Rich. No, sorry. No, I'm going to talk about that one.
I'm
going to talk about a bit of that.
Here's that hand grenade back.
Because, we bought into the fund at around the £8.30, £8.40 level. And since then, the crypto market has actually been pretty stable. Ethereum and Bitcoin have traded around the lower levels, but they've not actually broken to new lows or anything like that, even during this crisis. So bits of me say, well, one of the reasons we did it has actually worked quite well. The problem is that, and if you remember what we did was we sold NASDAQ into it. So we're definitely keeping our exposure to technology, but we wanted to have it via these sort of data centers and the energy side of things rather than software and stuff like that. NASDAQ has come back and that has brought this back with it. Now, I look at it and I say, I quite like the story still for the crypto. And I still like the story for the data centers and the energy usage and the linkages there into this ETF. To me, the thing that I am more focused on is the amount of risk running in this position. Because we have 7.5%. And I think if people remember, we said we keep a really good close eye on this because it's very volatile. And what I mean by very volatile, Mark talked about it earlier, being with the beta. But remember, I talked about it being the volatility of the portfolio, and that the volatility of a normal equity index is something like 16 or 17%. Well, this fund is about 58 or 60%. So it's very, very volatile. And I think in normal times, I can ride that. That's not a problem. But we're not in normal times. And we've had a lot of volatility here. And so the question to me is not, do we want to be in it or not? I think we do want to be in it, in my opinion. But have we sized the position correctly? And I think we probably need to just reduce a little bit the risk in that position. Because although it's a good position, we don't want to carry that much exposure. Go back to what I said earlier, the complacency of January, February, perhaps we felt that we walked on water and we couldn't do anything wrong. Well, we've just sunk. We haven't sunk, but we've got a little bit of a wet ankle.
We've been crucified.
We've got a bit of a
Easter.
We have not been crucified.
7%.
It's tiny, even when you look at the size of the position and everything else, and look at how much we've made overall. But it is something we shouldn't ignore, and therefore, I suspect that one of the things we can think about is just putting that position back a little bit, just to say, yes, we still like it, but looking at how risk changes, you'll remember back to a previous episode where I talked about when volatility increases, professional managers suddenly find they're carrying more risk than they think, and therefore they should cut a bit of that risk. It's the sensible thing to do. To a degree, it's sensible. We can talk about that in some other stage as to whether it is indeed sensible. But for us at the overall level, I think we probably want to cut back a little bit. Anybody else want to comment on there, or should we move on?
I think that's a pretty sensible ploy, actually. And I am a big fan of, as you know, of that, and having a bit more risk in the portfolio. I'm naturally a bullish person, and I think we're getting into the end of the war, and therefore, I can see that sort of there'll be risk on, as we say, in the markets coming back again, and we might just be taking it off at just the wrong time. And that's the only question we've got, is now the right time to do it. But in principle, as you say, we've probably got a little bit too much in there. 7.5%, I'd be happier probably with 5%, but I'd like to see some of that money perhaps invested in some of the things we might like. I think if we've got some catch up to do, like some of the other markets have been hit hard, or the US or wherever.
Okay. Talking about the US.
Let's go to NASDAQ. We'll take NASDAQ, S&P and FTSE 250 together. And Rich, thoughts on those? They've all been negative performers, but I think nothing more than the market's been, sort of thing.
Nothing more than the market's been, but we see S&P 500 down nearly 7% since the 1st of January. But most of it has been recently, and especially the NASDAQ on last Friday. So last week is where NASDAQ has been hit the most. Now, I've got a theory for you. Some might call it conspiracy theory, but it just makes sense, because we sat here 2 weeks ago and we said, well, Mag 7 is probably the place for safety, right? It's where people are actually putting flows into. And Chris, you stated you don't think the NASDAQ's got any downside. And we've seen it get thumped. We've seen treasuries get hit fairly aggressively. We've seen gold be hit very aggressively, considering it's a safe haven. Here's my theory. You've got 20 million barrels of oil that is not flowing out of the Strait of Hormuz daily. Now, that's coming from Arab nations that need those revenues, right? So suddenly you've been cut off from $1.6 billion of income daily. Where do you get that from? Well, the PIF, which is the Saudi Investment Authority, the Qatari Investment Authority, the Abu Dhabi Investment Authority, huge holders in Mag 7, in treasuries and gold. And those are the very liquid instruments that you could actually try and get some cash out of. So far in a 4-week war, then they could potentially have lost $100 billion of revenues from oil. And just in the meantime, they've sold out a few of those. So I think potentially that is one of the catalysts that we've seen particular weakness in the last 7 days. Now, to take it out over the quarter, as I say, NASDAQ, S&P, we know the story. We know it's well held. We know it was expensive. It's not expensive anymore. If those earnings are right, and we looked this morning, S&P earnings have actually nudged up a little bit, and the expectations for $330 of earnings this year. So to get the PE ratio, you take the price of the index, which at the moment is about 6,500, and you divide it by that earnings number, which is earnings per share for the whole index. And we say that's 330. That brings you down to about 19 times earnings, or 19 and a half times earnings. Now, that was 23 times earnings, which is regarded as quite a high multiple. 19 and a half is probably on average with the last...
Oh, absolutely. That's in line with the long run average.
Yeah. So considering we've got AI coming, considering we've got potential for a lot of cost savings, this is starting to look really attractive. I looked down some of the Mag 7 names, and Meta got down to a level $530, Nvidia $168, Google came off, Alphabet $273. Every single one of them, I thought, I would actually buy that here, and I'm meant to be the bear. So I've got to say, I'm warming up to these US assets again. Now, we've got the problem. They've all rallied overnight. They might rally again on Trump's statement tonight. But I'm certainly a lot more comfortable with the US than I have been since the start of the podcast. FTSE 250, well, that's operating on something completely different. FTSE 250 is working on the inverse of gilt yields. And as our expert in the bond market has told you what's happened to gilt yields and what's happened to Sonia, we were pricing in all these rate rises in the UK, still pricing in 2 rate rises. All that happens is when bond yields go higher in the UK, the FTSE 250, which is the best representation of the UK real industry, the FTSE 250 drops. And that's why we've seen a negative performance there of 4.8%, mostly in the last few weeks.
Okay, so the conclusion I think from that, and tell me if I'm wrong, is that the actual indices have performed as you'd expect in the crisis we've got, but what they're now getting you to is a valuation level that as long as the E is still going to be okay, then actually the markets are looking reasonably attractive. So there's a home for some of the money that we might raise if we do other things.
And I think it's important to try and rank, if you like, where you're most confident about that earnings. And for me personally, I think the strongest, most secure case for the earnings is still in America, because when we had Stu on last week, he was talking about, the US being able to weather another month or two of this conflict and higher oil prices, because there's so much stimulus been coming in through the One Big Beautiful Bill, and because they're not expected to put through interest rate rises. If anything, like I say, if the dovish new chairman comes in, you could get the opposite. So I'm most confident about the E in the US. I'm less confident about it in Europe, because although there is fiscal stimulus coming through to lift defense budgets and do all the rest of it, they've had a big spat with Trump, as we have. And, that could, at the margins, hurt some of the trade with the US at the margins. And we don't know if he gets his tariff gun out again, then he could sort of hurt Europe and the UK. So I'm more concerned about particularly European earnings. Just in terms of the E part of the PE, now, Europe and the UK trade on a much bigger discount to the US, like the S&P 500, substantial discount. And that also partly reflects some of the issues we're talking about. But yeah, if you said to me, where would you, mortgage your house and put your money, if you had to, on the earnings itself, I'd do it in the US.
Yeah, but you see, I don't, with respect, I don't think that's added anything to the conversation.
Thank you very much.
Because we all expect the earnings to be more solid in America. Nobody doesn't think that. Nobody. The question is the discount in the market on European, Japanese, UK assets, emerging market assets, sufficient to offset the fact that their growth will be slower? And we need to also remember that the reason why people were selling the US and going into these other markets was nothing to do with the earnings. Yeah. It was to do with Trump, right? And if it all gets sorted, I think people will carry on doing the same trade, because people don't want to be exposed to the US. So, let's not have the debate this minute. We're going through our quarterly piece here. That's why I said what I said the way I said it. We're identifying there's some value, but it's another step to say, I've identified value, therefore I want to buy it here. Because we go back to our catalyst, what's going to drive the value coming through. Let's carry on, and then we'll sweep up at the end.
Yeah.
So we've now got the 1 to 5 year gilt, which was down about 2.6%. Now, I have to say, for those people who don't really live in the wonderfully exciting world of bonds, sorry, who woke me up? Yeah, sorry. 2 odd % down is terrible performance for something that's pseudo cash. And what that is reflecting is this Sonia move that we talked about last week, going from 2 rate cuts discounted to 4 rate rises. And that is truly astonishingly poor performance. But given we like the outlook for the front end of the market, in the sense we don't think interest rates are going to go up 4 times or 3 times or 2 times or 1 time, but we actually think they may be being cut fairly soon, that will make no sense doing anything with this position at all. So as disappointing as it has been, I think we just sit with it.
Just to note, there's a new Bond novel coming out soon, Chris. And it's called King Zero. So is this going to become your new nickname?
I doubt it, mate. I doubt it. So then we are going to go and move on to something that was broadly unchanged, but we have a reasonably big position in. And that is copper. So over to you, Rich, to talk us through, are we happy with copper? Are we comfortable? What do you think?
Be relatively brief on this one. We bought our first allocation nicely. That was, quite a good purchase level. And then we added to it at a horrible level because I got all excited.
That was spicy.
We got all excited.
I am the kicking boy today.
And it just looked, for that first time in a long time, didn't it, Spice, that copper's story was at last coming through after 3 years of promising us that the supply situation, supply was going to be dropping and demand was going to be higher with data centers and autonomous vehicles and, all the demand looking good, Chinese stimulus coming through. All those things potentially are still valid. And the supply situation certainly hasn't improved. So you've got the backdrop of a potential rally, but it just, every time it looks like it's set to go, it gets knocked back. I'm happy with it. I hold it personally.
Emotionally involved.
As you say, it's been flat. If the world goes the right way, then remembering there's a lot of rebuilding going to be happening as well. Your story is intact.
I agree. And, part of the reason it's suffered is because it is a more industrial metal. And so when people are worried about growth generally across the world, as we've just been talking about, then something like copper gets hit at the margin. The reverse is true when that begins to reverse. And given it's not done great, but it's not a million miles from its recent highs. I think it could easily gather momentum again when people get more confident about the global outlook, which will come with the end of the war, or at least oil flowing back through the Straits of Hormuz.
So this is one of those dangerous ones where we all agree, so it's probably wrong.
Oh dear.
But to me, there's a technical expression in the market when you see its price action that we saw last week or the week before called a puke. Yeah. And it went absolutely down, 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 blew all the stops out, blew everybody out who could possibly be long of it still, and then rallied pretty quickly back up. So I'm with you guys. I think copper's fine. We've just got to sit and watch it.
And I guess that's this global growth story that if oil is at $150 for the next 6 months, then global growth is going to get hit hard. And this is the bellwether of global growth.
Yeah, so and I'll just reiterate on that point. It's the sort of logic you can see going through, and I'm going to be insulting here, second-rate economists who go, well, if this happened, if that happens, then this must happen. Oh, copper must get smashed. Starting with interest rates going up. Well, the interest rates aren't going to go up. So copper's fine. So to me, I'm happy with copper, which probably means everybody should go and sell. But anyway, let's move on. We're going to talk about some equity markets have done a little better than other markets. And we're going to take 3 together. The Nikkei, the FTSE, and emerging markets. Spicy, just give us a few words on what you're thinking on those 3.
Yeah.
We've crossed the threshold now. Now we're into positive territory.
Positive territory, yeah. Sorry, I should have said that, yeah.
Everything we spoke about until now is actually down on the quarter. And now the good stuff, Spice.
So, I mean, look, let's cover the FTSE first very quickly. As I said right at the beginning when we were talking about around the market review, the fact that the pound's been weaker, maybe a bit of nervousness ahead of the local elections, that actually ironically could help the FTSE 100. I am not very positive on the pound short term. I think, until we get through these elections and get through that uncertainty. Therefore, I'm very happy with a decent position in the FTSE 100. I think it will continue to recover. And it did have a correction, remember, a 10% fall from its highs. It got to just under 11,000. We're already with a 11,000.
10,000.
It got to just under 11,000.
Sorry, the other side.
Yeah, exactly.
But then got to below 10,000.
Well, back to it. So it fell more than 10% back there. Then that had that correction. Now it's bouncing back up again. So it's off its lows. I think that will continue that rally as long as, all things being equal. I'd be more worried about the mid cap just because they're more exposed to politics potentially. So take that.
So
I think
3.5% up for the first quarter.
Yeah.
So that's a good performance.
Yeah, I think, and that can be maintained. As long as, if the pound went rampant, then actually that would hurt it. But I think I'm in the camp that think the pound's at best probably stays where it is now. And maybe declines a bit more. Going to the Nikkei, remember we've got a new prime minister there who has got through some big fiscal changes. That's all about to start hitting the Japanese economy, start to benefit them. They've been hurt in the very short term, like so many other markets, because they're massive importers of foreign oil and LNG, liquid natural gas, to fuel their economy. If that oil price starts to drift off, the Nikkei should re-accelerate again. And personally, it's one of my favorite markets, if not my favorite market actually at the moment. So I think that will continue. And then the emerging markets, it's a very similar picture. We touched on it when we talked about India, but again, they're big importers of oil. And a lot of all these trades were very logical why they suffered in the short term, because the oil price going up, that hurts them more than other places like America. But now I think if that starts to reverse, that'll be the same too. And as I said, if I maybe at the margin, I'll take a bit out of India. I'd happily put it into emerging markets. I still like emerging markets. The other thing is the dollar has been very strong against pretty much all currencies. What quite often happens in geopolitical events, the dollar gets what's called a bid, that people want to buy it. It's a safe haven sort of currency to put money in, that with the Swiss franc, etc. Those are the big safe haven currencies. And the dollar, if that comes off a bit, a weaker dollar helps emerging markets hugely because they borrow a lot of money in US dollars. So when the dollar goes higher, their interest costs go up. When the dollar goes lower, the interest costs come down. That's something the government can either spend stimulating the economy or companies can use reinvesting in their businesses.
I'm not sure selling India to go into emerging markets is maybe not shuffling the chairs on the Titanic, but shuffling the chairs on a EasyJet cruise ship.
Yeah, it's a way of just moving things around, keeping most of your exposures the same, but making you feel that you've got a fresh view because it's a fresh holding. But there's nothing wrong with that. We've said before, one of the things about the investment world is the psychology of investing. You might sometimes need to freshen yourself up by doing something like that, and then suddenly you see things a lot clearer. So I'm not against doing that. I'm more trying to work out what spices to use on the dollar. Because at one stage, he's saying he thinks the dollar's going to be stronger when he's talking about the FTSE. But in the other stage, the emerging market, he says he's going to do better because the dollar's going to be weaker.
No, Mr. Chairman.
It's called let's go both ways.
Mr. Chairman,
here we go.
I am specifically talking about pound sterling.
Oh, right. Okay.
Sterling.
Yeah, well,
because we have a big political event coming up, and that I think will weigh on sterling more than other things. I think other
do you not think that's in the
currencies.
price? Do you not think it's in the price? Because we talked about where the gilts, how badly the gilts have done. And one of the reasons gilts have done as badly as they've done is because there is some concern that come the elections, there might be a new prime minister, maybe, and some of that's in the price. Well, we've talked about that as to why have they done so badly, and that some of that's in the price. If that's in the price of that, it's in the price of the cable as well. Sorry, cable being sterling dollar exchange rate. So I think this is probably going to be one for another card, perhaps next week. But I am more negative on the dollar generally. So I like the emerging market position. I'm not negative on the FTSE because actually, if you look what happened in the first quarter, sterling did okay in stages and FTSE did well in those stages because the money flows into the UK buying sterling and it goes into the FTSE. So I see both sides. I don't think it's as clear cut. Where I'm with you is that it looks to me like the EM wants to go up. And if given any encouragement from the dollar move, it will move quickly. I'm totally with you on that.
Yeah, it's just a lever with many levers. sterling is down about 0.75% over the last week. The euro is pretty flat against the dollar, and the dollar index is basically flat. So sterling is the one, and that's why I bring it out. That I just think maybe at the margin, politics is beginning to weigh.
Right, on to BlackRock World Mining Trust.
Yeah, so the BlackRock World Mining Trust. Now, this has been a superstar performance, so clearly it was my choice. But it's done extremely well. It's up about 9%, and that is great considering what's happened in this quarter. But much as it was my choice, clearly, I will get Rich and Spice to tell us what they're thinking on it. So, guys, what are your thoughts?
Well, it goes back to a lot of the positions we've talked about. If you get this pickup in cyclicality as the oil price comes off, the Strait of Hormuz become less, of an issue, then I think that cyclicality attracts positive inclination towards metals and commodities in general. And the World Mining Trust is exposed to copper and iron ore and aluminium. And aluminium's had a very good week this week, ironically, because the Iranians attacked an aluminium smelter in one of the Arab nations. So the aluminium price went shooting up. Now, that may not be sustainable, but it's just part of that whole package. And so those mining companies should actually continue to better. And at the margin, the dollar comes down a bit. Again, that helps commodities. So I'm still very positively inclined towards it.
And we've got to remember that a third of the mining trust is in these precious metal names. So we've got gold, silver. Now, they had a really torrid time when the market was thinking, interest rates are going to go higher. But thankfully now you've had this big switch back, as we said, potential recession, a hit to growth, and interest rate expectations have come back down. Gold price has rallied quite nicely. We hit a low of about 4,200, even under that. And then now back to 4,600.
4.6.
Yeah,
this morning.
4.7 now.
4.7.
Spice is obviously trading it while we're on the podcast.
As real time as we can be. No, I think that, it's a good point. But I think we were scared that maybe that silver had become almost uninvestable for sensible investors because it was so volatile. But I think gold, yes, it got dragged down by the silver sell-off, but actually is beginning to perform a bit more as you would expect it to do.
Right. So if I sort of try and sum up where we've got to and think about things, we are unhappy with the way India has performed. We can see reasons why India should be okay, but we can't really identify the catalyst in the short term. And we were thinking that maybe we should sell some India into emerging markets. And then we talked about the fact that with the VanEck, we've got a little bit too much there, and that actually we could reduce that position down to 5%, not 2.5 out. And I think the consensual sort of view is that 2.5 should go into probably the S&P, something like that, because it now looks a lot cheaper than it was. Potentially it could go into EM, but probably I think the US, because we think that. So the big issue is we've got some ideas and trades and thoughts and ideas there. However, we are recording this on the April Fool's Day on Wednesday, and tonight the Donald is going to give a big speech.
So everybody knows what it is already.
Well, if your surname is Trump, you know what it is already, and you've probably dealt in many different places already.
Or do you?
Allegedly, allegedly. But we unfortunately don't have that advantage. And I'm mindful of committing us to any transactions when within 24 hours of this podcast going out, the prices could be +5 or -5%. And
you've got non-farm payrolls as well.
I'm actually reasonably reluctant to do anything because I don't want to get caught by a mismark.
Oh, yeah. I've been called many things. Miss Mark, I've not been called for a while.
So Mr. and Mrs. Mark, no. So a pricing which isn't good because of where we closed at 4:30 on Thursday night relative to other places.
It's also a short week for trading. Remember, you've got Easter coming up.
Yeah.
So you got, Good Friday, Easter Monday, that sort of thing. So not all of the markets are going to be fully functioning or properly functioning because some will be open, some will be closed. But I think that's also something to consider. There could be increased volatility within markets just for this short period of time.
Yeah, so it's a fairly unsatisfactory position because I think we're clear what we might like to do, but it's what about that risk of volatility in the short term? I mean, for example, if we said the market was down 5% tomorrow because Donald said he was going to send the troops in at 9 o'clock tonight, I wouldn't have thought the S&P is going to be trading particularly well.
No.
I wouldn't think any market's going to be trading particularly well, but the cheaper markets will have more defensive characteristics than the more expensive markets on that score.
I'll put something to you which I think we're going to have opposite views on. I would say we actually don't have to make the decision now. We can put a stop loss in. And if the Trump news is negative tonight and the VanEck's down tomorrow, we have to sell it. If it's positive and it goes up, then we can keep it. But I think if it drops enough, I don't think you want to sell it, do you?
We probably want to buy it, eh?
No, I think we've made it clear we do want to reduce the risk we've got there. And we want to buy, let's say, S&P out of it, let's say, as a perfect example. I just don't know whether there might be a stupid mark tonight at 4:30 or on Thursday night at 4:30, marking VanEck down 10% because some announcement comes out. But the S&P, being more liquid and more close to the score, actually is unchanged on the day. And then the next day, they reverse just because of the mistiming of everything. So I'm reluctant to change anything until we get the other side of the bank holiday.
And less volatility.
And then when it's less volatility, I'm happy to just put the things on because that's what we do, whether it's up or down.
Yeah. It's not like we're coming out of the market in the interim period. So if Donald says something good and all markets go, well, we benefit, right?
Well, but if you sell it, you benefit because you've 77%.
As long as you're keeping it with the market, but if you put it back in. But I'm with Chris. If I was going to do it, I would put it into the S&P or emerging markets. But I'd happily sit on the hands just for another week or so and just see what maybe we come to.
For it being 2.5%, I think showing the discipline that we are cutting a little bit of risk when we've had a bounce, as far as we know.
But we may not have had a bounce. By the time we get,
but we
may bounce the next day. But we may bounce the next day because he comes out and he says something different.
Yeah,
I'd rather do things in a stable market condition where I'm taking a view close to the actual price we're probably going to deal at, rather than just shooting it. You know, it's a bit like saying let's sell our gilts and put 10% in S&P. It's like putting your money on black and your money on red. You know, that's what you're doing. And so to me, I don't think we need to do that. We have position. We think that coming out of it, it's likely that it will be a better market reaction or a nothing market reaction rather than a very negative market reaction because we don't think that's what Trump wants. I'm not sure what extra risk I'm running by just running it for an extra week rather than if we've made the decision we want to do it. The only question is whether it makes sense to do it now over this big announcement. That's all we're trying to decide.
I'm actually more interested now that instinctively you chose sell gilts, buy S&P. That's going to be the best trade of the week now.
Well,
next week you're going to say...
Often that happens, of course.
Because that's the first one came to mind.
But often the things you don't really plan to think and say are the right trades.
Yeah.
I go back to the fact that if we let's say we did that, we're increasing our risk massively ahead of an event that could be either way. And I just think these are not great markets for people who can't deal all the time. As we talked earlier, if you're running your own portfolio every minute, every day, you're going to be in and out, you're going to be in and out, you're going to be in and out. Yeah. You put your money in 3 days ago, you take a bit out now because it's all running nicely. That's not what we're doing here. We're trying to set a long-term portfolio. And our long-term portfolio is set with an idea in mind of what we think is going to happen. I think we just got to let it run, get to the other side. Hopefully, we get some resolution tonight. And then what we're playing with next week, maybe that everything's gone up 5%, but at least we know it's set all then fair without...
But are we still selling it then?
Well, at the moment, I'm suggesting we don't do anything.
No. Next week, if it's gone up 5%,
yes.
Are we selling it?
You put it on the top of the blotter
Okay,
and you discuss it again next week because
Well, let's commit to that. If it's up 5% next week, we're selling 2.5%.
We'll look to reduce our risk next week as long as we have a little bit of visibility, a bit more visibility around some of these bigger events that are going on. Is the plan. We will clearly visit it next week, and I'll be doubling our holding.
Yeah, that's the thing. You find an excuse every week not to sell things.
Joking.
Right. Well, that is us out of time for that quarterly review. Join us again in 3 months' time. Let's see how we've done. Thank you very much. As we said, it would be greatly appreciated if you do leave us at the bottom. Just give us a little rating there on Spotify, on Apple. Drop us a comment and a like and a subscribe on YouTube as well. That would greatly help us and be very appreciated. Thank you very much for joining us, and let's hope for a good announcement tonight.